Today I am joined by Dave Mcleish. You are the founder of Wedge.
Wedge is a savings provider, and we're really taking on the banks to try and provide a better savings rate than what the banks provide, and that's largely down to using our investment expertise.
And you've been an investment professional for your whole career.
Like you said, my background is investments, mainly in particular fixed income and cash, so the dull and boring side of investments, but also I think that there's lots of nuances and lots of expertise required to be able to manage conservative portfolios. So we're bringing that into Wedge and taking on the banks.
Hello and welcome to another episode of Wealth. Today I am joined by Dave Mcleish. You are the founder of Wedge and you've been an investment professional for your whole career. Why don't you give us the too long didn't read on who you are and kind of, what you got you here?
Yeah, great. Thanks for having me, Charlie. I've watched a few of the podcasts and really enjoyed it. So thanks for having me. So Wedge is a savings provider, and we're really taking on the banks to try and provide a better savings rate than what the banks provide, and that's largely down to using our investment expertise. And so, like you said, my background is investments, mainly in particular fixed income and cash, so the dull and boring side of investments. But also, I think that there's lots of nuances and lots of expertise required to be able to manage conservative portfolios. So we're bringing that into Wedge and taking on the banks.
That's awesome. You mentioned boring, and you ended up in fixed income. Have you always been in fixed income?
Yes, I started in equities for a very short period of time, and then I saw the light and moved to the smarter side of the equation. I did about 18 months, 2 years as an equity broker out of university, and then I went overseas and was straight into fixed income, and in particular credit, actually. Trading of corporate bonds and alike.
Cool. And did you always know you wanted to be in finance when you were in school and stuff?
I did and I didn't. I think as a young boy, you've got quite a few different ideas. But one thing that was very clear to me was I was going to need to have a profession that was satisfied my competitive streak. I was very, very competitive as a child, and very sporting. That was my avenue to kind of release my competitiveness and to be able to mix it on the either rugby field or cricket pitch or whatever it might have been. And so markets really excited me largely because I knew that they're a really hard game to be playing, right? You're taking on the best minds, the best technology, the best everything that is out there trying to make money at any one particular point in time. And that's kind of the collective knowledge of the market. And so competing with that is quite mind-blowing on a daily basis. And that really excited me. So short answer is yes, I really found markets and investing interesting from an early stage, and that was largely because of how competitive I was.
So do you remember when you made your first investment?
Yeah, I do. It wasn't a particularly well thought out one, to be fair. I haven't actually really shared this with anyone before. But so I used to work at ASB Securities when I came out of university, and I was an intermediary broker there, and we would do the odd sort of IPO and the like. And I learned a bit about one of the businesses that we were IPOing at the stage, that the managing director there had a very personal relationship with the founder. So got on the ticket, and I put some money into that. And then also the other initial investment that I made was in Frucor Beverages, the guys that used to make V. That was another one because back then I was an energy drinker and I really liked it, and I thought, hey, this is a good business, and so those were my first two investments.
Oh, interesting. How long did you hold on to them for?
Not very long. The IPO went really well, and so I kind of flipped it out probably way too early because the share price did continue to increase quite well. And Frucor, I actually got scared out of it during the 2000 kind of dot-com boom and bust, where, you know, all markets went down pretty heavily for a short period of time. And again, that was just an awesome lesson learnt around, you know, time in the market and timing the market and some really important lessons. So thankfully didn't lose too much money over them. They're always the best lessons to learn. But that was, they weren't particularly long. They were more speculative investments.
Yeah, cool. So you made a couple of investments. You're working as a broker. And you then probably did the standard Kiwi thing, which was to go overseas, especially if you work in finance, because it seems like everyone's done a stint. And did you go to the UK?
I did. I started out at the UK.
Also,
Did have a short period of time over in New York as well. And that was largely through a placement when I was with Morgan Stanley at the time. Lived and worked in New York for a short period of time, but all the rest of it, of the 10 years or so that I was away, most of it was in London.
And straight away in those two locations, it was all fixed income corporate bonds.
It was
all corporate bonds.
All corporate bonds. In saying that, there was a little splattering of structured product in there as well. So that was back in the days when, you know, CDOs and CLOs and so on were big, and they were a natural kind of offshoot of the credit market because essentially they were packaging up credit products and leveraging them and then on selling them. So there was a short period of time with structured credit as well.
What's the most misunderstood thing to everyday investors about bonds and fixed income versus what they think of around investing?
Yeah, it's a great question. The most obvious answer to that is that people are scared, in my opinion, of things like cash equivalent and fixed income securities. They kind of view them as complex. They view them as therefore hard to understand and potentially therefore actually riskier than what they really are. There was actually and I'm going to go off on a little bit of a tangent, but there was a really interesting article written by one of the New Zealand journalists recently. I can't think of who it was, but it was in response to a reader's inquiry about isn't this next bond fund just another too good to be true story, or isn't this the start of another blow up? And I was kind of it took me back because I kind of read it and I thought, well, actually, you know, people, the average New Zealand punter, I think, has probably got the wrong end of the stick. And even though fixed income or bonds or all of these different terms that we have for income generating assets are relatively complex, they are actually very, very safe and secure in most respects, largely because inherently they have a legal commitment to pay a certain amount of income to the person that owns the instrument. So that financial commitment is one that is usually supersedes any other claim that another investor, like a shareholder in that business, has on that business's assets and its income. So naturally, you kind of sit at the top of the queue to get your money, which makes them actually, in most cases, a lot safer than, say, equity investments and the like. So that's probably the biggest misconception in my respect, is that just people, A, don't understand, or B, don't care to understand.
That's such an interesting dynamic, because I guess we then go and give that obligation over to a bank to then sort out that, and then they do their own lending anyway, so they're actually, you know, creating their own kind of loan book from your deposits.
That's exactly right. So, you know, in many respects, a bank does very similar things to, say, like what Wedge does. They take in money and they lend it out. In between, for a bank, and where there's a really big nuance between what a bank does and Wedge does, is that the bank borrows that money essentially from you. And so they have complete control over where that goes, where that money, where they want to deploy that money, be it high risk, low risk, somewhere in between, high margin, low margin, whatever it might be. And being a creditor to the bank means, yes, again, you sit kind of at the top of the queue, but equally you're in a queue with a lot of people as well alongside you. And so the banks themselves inherently take that money and are doing this lending, which is the same kind of thing as bond investing. But at Wedge, where it's different is we take in clients' money into a fund. Wedge doesn't touch it. It's not a liability of Wedge's. It is entirely their money and stays their money. Exactly. It's their money. They have the beneficial right to it. And the supervisor of the fund looks after that and makes sure that Wedge doesn't have any control over it, and also that money is therefore invested in a very, very specific set of high-quality assets.
Yep.
So therefore, there's no way that Wedge can go and take undue risks, whereas the bank can. So in many respects, thanks to the FMC Act, which came into play after the finance company blow-ups, we've actually now, the industry, and in particular the savings industry, has become much more tightly regulated and much more defined and much more protected to end investors.
Yeah, that's cool. And I think that point you made around the mandate of how the allocation is done in a fund is very different to a loan, because a loan, you're essentially giving the opportunity for the operators within the business to then make decisions to utilize that capital in order to get a return for the loan. And, there may be an obligation like an interest rate that you're receiving, whether it be in a bank or other means, including funds.
Yep.
So you were always in the fixed income market. You must have then gone through the 2008 crisis.
Yeah.
Given that you were in the UK at that point, or were you in? Yeah.
Yep.
So that's pretty big, because it was big there.
Yep.
It was massive.
Yep.
And obviously in the US as well. And in a sense, New Zealand didn't experience the same 2008, in my opinion, that the UK and the US experienced.
Yeah. Absolutely. Yeah, that was a really interesting time. At the time, I was at UBS and had just been offered a job at Goldman Sachs. And so I was kind of in that decision, in a bit of a void between those two banks and making that next career move, pretty much bang on when the GFC hit. So that was a particularly unsettling time for me personally, but also, standing on a trading floor, managing a lot of risk for a bank at those particular points in time, and seeing how quickly markets moved and how quickly liquidity evaporated, and really a lot of those primal instincts that are not particularly helpful, that sit inside of humans, really coming to the fore.
Yeah.
The fear and greed I'm talking about, and all of those different biases as well that we have. And so that was a huge learning curve for me. Each crisis really has been. As I say, the first one was back in the .com. Yep, exactly, 2000. Each of them are different in themselves, but huge learning opportunities.
Yeah. And was there a moment that you can think of in that was kind of the tipping moment that you think about a lot as a kind of in your memory?
Yeah, yep, absolutely. There was the thing with the global financial crisis was there was lots of tipping points. It was actually kind of this rolling crisis. If you kind of think back, 2008. Third quarter, fourth quarter, 2008 was when cracks started to appear, and you kind of thought this was the moment. And then things didn't really heat up actually until kind of February, when the BNP structured product kind of blew up, and then Bear Stearns and Lehman Brothers was kind of March, April, May. So that's almost spanning a year in itself, and then it felt really strange because that morphed into the sovereign crisis in Europe. And the sovereign crisis was kind of 2010, it started into 2012, which again was the banks creating a crisis in their own sovereigns because the sovereigns had to step in to bail out the banks.
Yeah.
And so that whole period from kind of 2008 through to 2012 was just this rolling kind of, it was a roller coaster, that's for sure, of emotions and trying to navigate different flare-ups in financial markets. And in most cases, the flare-ups occurred actually inside of the credit markets because, again, that's where there's assets and liabilities having to kind of find the right value. And when you've got human instincts over the top of that, things can get pretty hairy pretty quickly.
Yeah, I think that we take for granted, especially in equity markets now, all of the added liquidity that has been created by the industry growing and creating ways to provide liquidity.
Yeah.
We look at today versus even in 2008, the amount of derivatives used today is very different to back then. And it's more driven by, everyday people even. So that creates kind of a very similar situation to what we saw in 2008 with basically layers and layers. It's like an onion that you don't really know how many layers there are. Yeah. And that was basically the problem and it was a little bit like the FTX issue when the Binance founder realized that there was the hole in the balance sheet, and he basically attacked it by creating a way in order for them to have to buy shares off of him or tokens. I can't remember the specifics, but very similar situation where if once the crack emerges, then it just kind of it cascades.
Yeah, it does. You're exactly right. What we typically find is things move really, really slowly until they move really, really quickly. You can kind of see a lot of things on the horizon, and a lot of those vulnerabilities, those very small kind of fissures or cracks in the system. And most of the time, we kind of drive over them and it's okay. But then all of a sudden, one of those just opens up and it becomes a very big problem very, very quickly. So one of the lessons really that I've learned out of that is never take your eye off all of those fissures. And when they start to become slightly bigger, react quickly. You need to be, and this is maybe a bit of a plug for the investment management industry.
Yeah.
Is that you do need people that are looking at this all day, every day.
Yeah.
To navigate correctly through those types of environments. It's very difficult when you go back to those human instincts as a mum or a dad sitting there having money in the share market or money in an investment fund and seeing all the headlines and how quickly things transpire, having that expert, be it a financial advisor or an investment manager, or at least just confidence in the people that sit behind your money is just so very, very valuable because it really is a full-time job staying ahead of and being aware of those cracks and how they may or may not open up.
And given the structure of how the industry works and where, I guess, allocation has gone, like in equities, how much action is being taken? Probably not much. Is there a lot more action that is taken in a bond and a fixed income portfolio, do you think? Like in terms of activity, where do you think the activity is higher? Perhaps it is it, would you say it's in the fixed income space just because you've got different durations and you're constantly working out how you're going to allocate and obviously then reallocate if you're obviously, having to rebuy bonds?
Yeah, it's a great question. So I think first and foremost is there's different levels of activity and styles and strategies of different, say, managers or investors, both in equities and fixed income and commodities and you name it, asset class. So it's hard to kind of be very definite around, hey, this is how equity managers work and this is how fixed income managers work. But what I would say is that through my experience, the turnover of a portfolio for an active manager is usually larger or higher for a fixed income manager than it is an equity manager. And you're exactly right. Why is that the case? Well, in many cases, it's just the structural difference of the two asset classes themselves, not the strategies that the managers actually implement over the top of them. Because as you can imagine with fixed income, just think about the fact that they're reducing in duration, getting closer to maturity every day.
Yeah,
right. That's right. So they're going to mature.
You're getting closer to a decision every day.
Exactly. They create income every day, so they accrue interest, which has to be then redeployed or thought about the reinvestment implications. They're getting close to maturity when you're going to get all of your principal back. But also each day they change therefore in their risk dynamics because they get closer to maturity. By and large, they carry less interest rate risk, less credit risk, those sorts of things. With a share or an equity, they don't.
Yeah.
They change with the fundamental changes in the underlying business for sure. But the actual instrument itself is a share. It's an ownership.
Part of a business.
It's a part of the business. It's a piece of ownership. And that's a perpetual instrument, right? Goes on forever.
That's right. In theory, there's less things to do.
Yeah, correct.
In an ideal world.
Yeah, absolutely. And therefore, in practice, in many cases,
that's right.
There is more things to do in the
and we've seen that portfolio. Time and time again with track records, indexes, of course, as well. But although I would say that indexes get this again misunderstood kind of narrative. You can't beat the index, just invest in the index. Well, what even is the index? The Japanese index was down for 30 years. So I think an index is just a group of things that could be equities or bonds. And I think we get mixed up with what these terms kind of mean sometimes.
Yeah. It's an interesting point. My take on that is what we do as active managers. Now, again, we'll probably talk about it in some point around what Wedge does. And Wedge is very much on the conservative side, and our active investing is really just rolling over very short-term, low-risk investments.
That's right.
But taking a step back and talking about indices and about kind of the broader active versus passive management discussion. Each of them have got their benefits, right? But you did right, looking at the passive side of things, which is essentially investing in an index. You are spreading your investments across, in many cases, a large number of investments. But if you're looking now at, say, the NASDAQ or the S&P 500, you really are very concentrated in Mag 7 or a very small number of companies because they've grown to such a huge size, and those things are market cap weighted. So you really do need to know what you're invested in. And in saying that, though, and this is the argument for and against active management, is active managers have to prove their worth because they're more expensive. Right?
For sure.
And on the equity side of things around the world, on average, equity active managers are pretty bad at producing value and actually outperforming the market or these indices. So it really goes to saying that that's really difficult, that job, to be an active manager.
For sure.
And you really have to know what your edges, your point of difference exactly.
What game are you playing?
Correct.
And I think that, a lot of the times we think about our Kiwi savers and we think about these structured things as they are a thing and they're almost all the same, but they're not. What game are you playing? Are you basically trying to roll short-term maturities and maximize your yield for your clients and protect against kind of risk? Or are you is your edge that you're really good at investing in a concentrated portfolio of energy stocks? I don't know, but you're playing a game, and then that's a part of an index.
Absolutely, and that's really, really important. I think that's a great message to maybe sort of give some of your viewers is not only is it really hard what we're doing, which is to beat the market, but the second point is don't play games that you either don't know the rules about or don't think you can win or don't know you can win. You don't know what it is that makes you good and better than the average person, because, in many respects, this all boils down to how do you be successful in investing? And in my opinion, there's just two simple requirements. You need to be right quite often, hopefully more often than you're wrong. Doesn't necessarily have to be the case, and we can talk about hit rates of great investors over the years.
True.
But being right is a prerequisite. You have to be right sometimes. But more importantly, the second element is you have to be different. You actually have to have a different view, because consensus, the view
is the index.
It is the price. It includes all of the knowledge of the collective market inside the price of that index right now. So you have to have a different view, right? So different and right is pretty hard. So you've got to be able to do both of those things.
That memo from Howard Marks, I beg to differ. Or beg to differ, I think is the title. Whereas you have to, in order to get extraordinary returns, you have to not be ordinary.
Absolutely. Howard's a a real favourite of mine, real idol. He's obviously grown up and made a very, very, very successful business out of Oak Tree Capital. And that's in an area that, again, I sort of grew up in, and in particular within fixed income credit investing. So really understanding the businesses, the entities that are borrowing from him, and going really, really deep into the weeds there. That's his edge.
Yeah, and the great thing about, I mean, that's going really outside of, I think, like the scope of what Wedge is trying to do and what many fixed income investors are trying to do. But you have a great opportunity where the actual debt may trade lower than the par price, right? So you could, what I've seen happen in like bond markets is the price moves on the actual bonds are immense, just like stocks in some cases.
Absolutely.
And he was very fortuitous in putting that. He basically had an emergency fund ready to go in 2008 with about $9 billion in it, which he was able to then go and buy that paper when everyone was freaking out because they had liquidity constraints. He was able to come in and provide that liquidity, and that if you're the only liquidity in the market, you have a ability to basically choose the price that you want to pay.
That's an interesting lesson that, some of the great investors keep teaching us throughout, in particular, big downturns. Be it Warren Buffett, the whole, be greedy when others are fearful, and fearful when others are greedy.
I mean, we could probably hit on that massive cash pile he has, but I wanted to go back to your journey and going from the UK back to New Zealand. When was that?
So that was 2012.
Okay. 2012. So then 2012, what did you do?
Sorry, we should start that again.
Okay, go for it.
That was actually 2013.
2013. Okay, cool. 2013, you came back, and then did you just get a job straight away? Did you have a little bit of a sabbatical or a break?
Pretty much straight away. I started having conversations with different fund managers and different market participants, I guess, for a few months while I was still in London, trying to potentially line something up. But equally, I knew that I had to kind of cut ties and actually have discussions face to face with people. So came back and then progressed on a few of those conversations. So it was a little period of time there where I could have some family time and kind of sort out exactly what I wanted to do.
And so you came back, and how many firms did you work at between coming back and then starting Wedge?
Just one. Yeah, just Fisher Funds.
So you were just at Fisher Funds.
Yeah, so I joined there. Carmel Fisher, who was the founder and still very much the managing director at the time. I started speaking with Carmel and then essentially offered up what I thought a cash and fixed income business should look like. Because at that stage, Fisher Funds was a pure equity manager, but that was very much at the start of their very, very successful KiwiSaver journey. So Carmel, to her credit, and the board saw the growth opportunity that was KiwiSaver, and clearly realised that a equity-only business was not going to be fit for purpose. And so the next asset class that made a lot of sense to add to their repertoire was cash and fixed income. So, and as I say, that's my background. So the two of us started talking, and 13 years later, that was kind of that was my journey.
That's cool. And did you know you were going to? When did you know in your life that you were going to start your own thing? Then, was it way earlier, or was it?
So when part of the appeal of joining Fisher Funds was the fact that I got to kind of set up a business inside of a business. So being an entrepreneur, and that for me was kind of a tester, a taste of that entrepreneurial journey that you can go on, and it's not for everyone, right? And to be fair, now as an entrepreneur, looking back, an entrepreneur is kind of pretty easy because you've got a lot of that support network. You've got those resources, and you've got a lot of support there and knowledge inside of your business already to help you take multiple leaps very quickly. So I was very, very lucky to be working with some great people throughout those years. But it was still felt to me like it was my baby. You know, I created something inside of something, yes, but you know, that was the driving force for kind of the 10-year strategy inside of setting up cash and fixed interest at Fisher Funds. So yeah, when I got to about the 10-year point, I started to get itchy feet. And so really for the last 3 years, have been working on Wedge and then launched it kind of officially just last year.
That's right.
So, left Fisher Funds last year and then launched it this year.
Yeah, that's cool. And where do you think, like, you said it was harder. So what would be the most interesting piece that you didn't expect?
Ooh, that I didn't expect.
Yeah, what was the biggest, like, whoa, I didn't expect that moment, maybe?
Okay, probably my biggest underappreciation for going out on your own was building a digital business.
Okay.
With no digital expertise.
Okay.
I kind of relied on, you know, we're probably classified as you guys are as a fintech.
Right.
I see myself way more as a fin than a tech.
Yeah.
In the sense that internally, our investment capabilities, our finance capabilities, the fin side, is a point of differentiation.
Yeah.
That's our value proposition. We provide, you know, access to wholesale markets, which gives people a better savings rate.
Yeah.
Right?
Yeah.
They can't do that themselves.
Yeah.
So that's our value prop, not the tech.
Yeah.
In fact, the tech is really just the channel or the distribution.
The experience that people basically relate to the brand and the product.
Exactly. And that's the point, right? So that's what I probably didn't appreciate as much is that I've heard of lots of non-tech founders setting up fintech businesses. And therefore I kind of thought, well, hey, this is just the conduit. This is just the platform. How hard can it be? It's getting really cheap to build websites, apps, all of this kind of stuff. That's going to be the easy bit. You know, the real value proposition, the hard bit that no one could replicate is our finance and investing skills.
Yeah.
That's true to only a very small extent. The tech side, there is a lot more to it, and I'm learning along the way.
Yeah, okay, cool. And then how's the uptake been with customers? Like, how do they think about, savings, and what are the big objections versus the, I guess, the lessons you're kind of teaching the market, or the kind of insights you're teaching the market? Like, is there anything that you've kind of really felt like has been interesting in that space?
Yeah, financial services more broadly is a trust business, right? Mm-hmm. And trust can be earned in actually quite a few different ways. One of them in particular is just being present for a period of time.
Yeah,
right.
For sure,
earning
for
that
sure.
trust,
staying alive.
Yep. And so I think that is an important element that we just kind of have to prove out the business model over time. But equally, there are other ways of building trust. And our background and track record is certainly trust building. So I've been really humbled by the fact that there's been a lot of previous investors and people that I know and that have known my track record and my team's track record that have kind of come on at a very early stage in the business and backed us.
Yeah.
And so that's that's been, as I say, very humbling. But yeah, trust is by far and away the most important thing to us. And being present, being on podcasts, having a very trustworthy, slick, reliable interface is very important. That builds trust. Being present in the media, all of these sorts of things is a very important part of our business now.
Yeah.
And thankfully already we've started to gain that trust. And so we've just got to keep building on that.
And I think what's interesting about your product is that it's so focused. You're not basically boiling the ocean.
No.
Which is really interesting. It's like, hey, we're going to be really world-class at this thing. And by the way, at the moment in the market, the dynamic of this country means that actually we get to do it really well and that creates a huge opportunity for consumers.
Yeah. No, you're exactly right. Being that almost one-trick pony.
Yeah.
I think there's a double-edged sword there.
Totally.
But we really want to be and are known as the alternative savings provider. We're the alternative to your bank when it comes to savings.
Totally. And another thing that I've noticed in the recent past is there are a lot of people that have gone out and started things in the fin space or the fintech space recently. There's been an emergence and an uprising of new incumbents, but also investment professionals taking the leap of faith to actually do something. That seems like a bit of a shift. Do you know why that's the case?
Yes, I think I do know, and now know is obviously a fairly confident statement. My gut feel is that we've seen a lot of these playbooks already in other parts of the world. Right. Although ours is an innovation to the local market, our model has been proved out in lots of other bigger markets for quite a few years. The same can be said for other fintechs in New Zealand, I think. And it's actually, broadly across financial services, it's what we see. We see it time and time again, whereby a new product or a new way of thinking or a new strategy or anything that usually originates somewhere like the US or in Europe, starts to make its way down through Asia, finally makes its way to Australia, and then lo and behold, maybe 6 to 8 months later, New Zealand you start to see a presence of it in New Zealand. I don't mean to be derogatory to our country, but that is naturally how a lot of that innovation does evolve. So we're not, like you said, boiling the ocean or recreating the wheel or doing all of those sorts of sayings. We really are just taking essentially what's been a pretty proven business model and bringing it to New Zealand. And I think a lot of the other fintechs are latching onto that. And that is great for New Zealand, right? Because not only has the entrepreneur or the fintech got a blueprint, they also know what impact that can have on New Zealanders. And without that impact, without that, greater competition in many cases is what we're really bringing to the table. Without that competition, New Zealand will continue to be hamstrung by the old ways. By money flowing offshore, for example, to bank holding companies in Australia is a really good example. And so that's for the greater good.
Yeah, for sure. I think, don't quote me on these numbers because it's been a while. But I think I was looking at the deposits in New Zealand that weren't getting the rate that they should be, which is about 120 billion from what I could see. And it was like, I was working out the differentiation of like what's being got on average or the median versus what they could be getting was like something ridiculous, like billions of dollars a year, $6 to $9 billion a year or something of unrealized kind of profit that's essentially, like you say, being exported offshore. So I think that's something that we need to really like kind of hone in on, is that there's actually $1 trillion of market cap in Australian banks. Right. So if you think about being a fintech that actually solves a real problem in this region and Australia, for example, just as two components, for every 1% of market share you take away from those banks is in theory $10 billion of market cap that could go somewhere else.
Your numbers aren't that far off on all of that stuff, so you've got a good memory. You're exactly right. So from our perspective, when we looked at the New Zealand banking system and in particular the savings market, and we compared it to other similar markets, other similar banking markets like Australia itself, Canada, the UK, who've got very similar mortgage markets and savings markets, and you go, okay, so where do the banks make their money? And your starting point is the official cash rate or the cash rate, the federal funds in the US, wherever it might be. And you go, okay, so how much less do the banks pay for deposits and how much more do they charge for mortgages away from that midpoint? And our analysis suggests that actually mortgage rates aren't particularly any worse, i.e. higher compared to our cash rate than what you would see from a bank providing in the UK, Aussie or Canada.
Right.
Where they make a lot of that money, where they make their $10 billion of profits every year, is largely by paying so little on the savings side of things.
Right.
So there's a lot of interest-free accounts, transactional accounts, but there's also, to your point, a lot of very low-interest savings accounts, be it an on-call savings account, be it a bonus saver, be it a notice saver. All of those accounts wrapped up are, in many cases, hundreds of basis points or many percent below the official cash rate, which, in our opinion, is not only where they make their money, but the opportunity for us to really create a difference.
Yeah, okay, cool. And then, if, you've been at this for 3 years, especially in fintech, it's a very slow compounding game, but wow, does the compounding maker is truly profound when you look out 5 years, look out 3 years, wow, we've come a long way. Yeah. 5 years from today, what does success look like for you, do you think, with Wedge and with what you guys are trying to achieve?
Success in 5 years' time, let's be a little bit more aspirational and say in 10 years' time, success to us looks like saving New Zealanders $1 billion.
Okay.
That is true success. Now, does Wedge play a part in that? Absolutely. But we know at Wedge that that's going to take a village, right? And that in many cases we will need to create a movement that is not just about Wedge. It's actually about innovation and about better ways and competition in many cases. We would and do encourage competition in our space. We're the first savings fund. We want to see more savings funds because together we can actually achieve that goal. That $1 billion of savings per annum
of course,
for New Zealanders by simply giving them a better savings rate. So that's what success looks like.
Yeah. I like that. There's a nice round number, $1 billion. It's achievable, it's feasible, and it's on the table. And guess what? The Australian banks are already taking that and more from our savings. I find it really frustrating because I get it as well, of, we have to vote with our money. You can't complain about cost of living or banks or price gouging or, these things if you don't vote with your dollars. And that's exactly what we've been seeing in the crypto market, of basically people not trusting institutions, therefore voting with their dollars to be out of these traditional financial rails. And then obviously you've seen kind of a follow-on from institutions, which has been obviously a big shift. But ultimately, if we want to see change, we have to go, well, I'm not just going to talk about using Wedge. I actually have to take my money from a bank and put it in something else that is doing something different. And that's actually the change that needs to happen, is that the collective needs to go, okay, I need to actually vote with my dollars.
No, absolutely. And I think that there's lots of different ways of looking at that. You're exactly right. One of the ways that actually one of our own clients kind of portrayed it to them was, how is having my money in a bank savings account, which is accruing interest at a rate much below inflation, the safe option? i.e. I'm losing money, I'm losing purchasing power, I'm losing the future value of this money every single day. Losing money every day isn't the safe option.
No.
Right? And so there's lots of different ways to look at that. And we're providing a safe option that actually gets you ahead of that inflation rate, so that you're not actually, you're not any worse off, but equally you're incentivized to save. And that is one of New Zealand's problems, I think, is our lack of savings.
Right.
And why are we so bad at saving? Well, in most cases, we're so bad at saving because, again, the incentive, like I just mentioned, i.e. the rate that the banks pay you to save is so low. You are so disincentivized to save. Why would you? And then when you add tax on top of it and all of those sorts of things, it's like, well, what's left? Not really a lot. So we're also, out there, the $1 billion of savings for New Zealanders is, just savings on the total pool now of savings. Right. We would hope that New Zealanders get better at saving through the incentives that we can offer, through that actually you can get ahead by saving.
Yeah. And I guess it's also like there's a lot of financial products consumed in New Zealand unknowingly as well.
Yep.
Like we're always consuming financial products and we sometimes don't think of it as consuming something. But I mean, from some of the work we've done, especially in the kind of net worth tracking and the kind of data that we've seen around kind of incomes and expenditures in New Zealand is it seems to me that, and I perhaps wouldn't have thought about it immediately, was that it's almost like there's too many financial products being consumed unknowingly. Mm-hmm. And I think a big shift in this part of the world needs to be knowing what you're actually paying for, because I think there's not a lot of transparency in kind of what is the true cost in all sorts of stuff. But that's something that I think is being forced upon the market right now.
Absolutely. And I think that's a great thing, right? The extra transparency is really important, because, again, that builds trust as well. That builds understanding and trust. And without transparency, you do, as an industry, kind of subject yourself to bad actors. And so added transparency gives people a lot more information at the outset about the decisions that they're making, be it that they didn't even realize they were making a decision or consuming that particular product, but at least they know what the value proposition is. What's in it for me? What's in it for them?
Yeah, and am I protecting myself twice over sometimes? Yeah. I've seen that a lot of like different insurance products and stuff where it's like the user is actually having, I'm solving this issue, right? Which is maybe I'm concerned about, my level of income and I want protection in some way. Mm-hmm. And then, there's another product that came up 6 months later. I wasn't thinking that I've already solved it once, but I still have that same fear. Mm-hmm. So then I do another layer. And then all of a sudden my cost of that fear might be 6% of that kind of value every year or something like that.
Yeah.
So I think that whole having a strategy behind your money and behind your wealth is super important, so that even though, and we know this as entrepreneurs, even though every forecast is wrong, and it should be wrong to the upside or to the downside, realistically, is that it's actually just better though, even though you're wrong, having a strategy, because it gives you the next move.
Yep.
And I think in New Zealand, there could be more, we could have more, I guess, incremental ways of giving people steps to progress.
Yep.
Like, here is your next option to improve your kind of wealth.
Yep.
And it may not be a new product, it may be a habit, or it may be something seemingly unrelated to wealth, but very important. Like, who is your best friend? And how much, what's the equity value in your friendships?
Yeah, I like that concept, because in many cases, making sense of and having a strategy for your entire financial position is a huge task and really daunting to people, and in many cases too hard, right? It is for me. So I think maybe those incremental steps, having ways to be able to help people bite off little bits to be able to get to that end. I like that too.
That's a good idea and a good point, because it is daunting.
It is.
But super liberating once you've done it.
Oh, very much. And even just each step is super liberating.
Like you're taking a padlock off of the door every time you bite away at.
Yeah. And we are very much, you guys are more the whole picture, but we are really just one of those steps, right? Yeah. We're just saying, hey, get your savings working harder for you.
And what is my saving strategy?
Yep.
And how much savings should I have?
Yep.
And how much should I have as a collective household, because I may have a different idea of how much cash reserves I want versus my partner.
Yep.
And actually the alignment here is super important, because they're not going to be the same number, but you might be able to find a number in the middle that then the household becomes happy with. Then that strategy's done. Guess what? You don't have to probably think about it much.
Yep. Exactly.
Yep. This is awesome. Well, we've been going for a while, so I think we'll put a pin in it for now. But would love to have you on the podcast some more.
Great.
And why don't you just give a quick kind of how do we get to find out more about Wedge?
Yeah, sure. So Wedge, again, is an alternative savings provider. We offer, at this moment, it's just one account, simple on-call savings account. It has a set rate of return, so people know exactly what they're earning after all fees and expenses, just like you'd get with an on-call bank savings account. So you can access that on our website, which is www.wedgemoney.co.nz, or you could download the app on either the App Store or on Android, Google Play.
Awesome. Okay.
Great. Thanks for having me.
Cheers.